Hi students, let's start budgeting in this video. Budgeting, initially it has some theory areas to understand, like different types of budgeting, what are the processes or steps in budgeting, what are the other considerations like sustainability considerations. All these are preliminary part of budgeting. Once that is done, then we will move into the budget preparation. Sales budget, production budget, material budget, labor budget. Once that is also done, then the budget implementation part. After implementation, then we can go to the next block of the syllabus, which is standard costing and variance calculations. So in this one, we are going to see the introductory part of budgeting. Chapter 13 as per the BPP book, budgetary systems. This is the syllabus learning outcomes. Always after the end of the chapter, you can come back and check whether you have achieved all these learning outcomes. Right. This is chapter overview still. Overview is like a summary. This is a summary diagram. These are the points we are going to study. Incremental, zero-based, activity-based, rolling. These are all different budgeting methods. Fixed budget, flexible budget, ethics and sustainability, changing budgetary system, budgetary control, budgeting and uncertainty. Objectives of budgeting systems. You can say objectives, you can say purposes, or you can even say advantages of budgeting systems. Better to know around 5 points. If they say state the advantages of having a budgeting system, you can mention a couple of them. Or if they say explain or elaborate the advantages, then you must be able to explain each of these points a little bit in detail. So look at this. First point says ensure the organization's objectives are achieved. So what happens? These objective means, your long-term targets after 5 years where you want to be. 5 years. This is where you want to be. Currently you are here. So we have to set a roadmap how we are going to achieve it. After 1 year we should be here. 2 years here. 3 years here. 4 years here. This roadmap is prepared through budgets. First year budget will take you from where you stand until the first year end. Then second year budget will take you there. So having periodic budgets ensure that you are traveling in the right direction to achieve the budgetary targets. Second one, compel planning. If we don't do budgets, we will not be doing planning. In the sense, if there are going to be any issues, for example, a company is going to face a cash flow shortage in the 5th month of a year. If they prepare the budgets well in advance, they will get to know there is a cash flow shortage coming. If they don't prepare the budget, only after the shortage has come, they will realize, oh, we are in trouble. So this helps preparing budgets, compel the managers to plan in advance and identify any opportunities or any threats early. Communicate ideas and plans. That means you have different layers of management. You know that strategic level, tactical level, operational level. So, for example, if it is a top-down budgeting where strategic level prepares and passes the budget to the bottom level, they communicate the ideas to the bottom level, operational level. Or if it is participative budgeting, other way around. We will study these budgeting methods in detail. Participative budgeting means lower level managers, operational level managers, they get together, they prepare the budget and they send it to the top level. So communication happens. Coordinate activities, different departments, sales department, production department, purchase department, finance department, HR department. All of them, when they do the budgeting process, they all sit together. They all get connected and they prepare the budgets. So it's coordination of activities. Just imagine purchase department and production department are working without coordination. Then what will happen? Sometimes there might be over purchase of raw materials and you might have too much of inventory. Or on the other hand, sometimes there might be a shortage of inventory. Production might be on halt because there is no inventory. But it has to be coordinated. If we coordinate properly, that doesn't happen. That coordination, budgeting is a tool for that. Provide a framework for responsibility accounting. Responsibility accounting means every manager has a boundary. He has a responsible area. He has some resources under that. He uses all these resources and he achieves his targets. So this boundary setting is done through budgeting. We are telling, okay, look, you are responsible for this team. You are responsible for this part of the region and you must achieve these targets. So we are giving him a definite segment of performance. We are defining his boundaries and giving targets. Through what? Through budgets. Establish a system of control. In management accounting, control means always comparing the actual performance with the plan. Because when somebody performs something, how do we know whether it is good or not? You compare with what was expected. So to do this, we need budget. When a quarter finishes, when a year finishes, you take the actual performance and you compare with budget to see how well the managers have performed. Motivate employees to improve their performance. How? By giving budgetary targets and connecting their incentives to budgetary targets, they get motivated. All these are objectives of budgeting, planning. Purpose of budgetary control. So that is being summarized here. Prime. P stands for planning, responsibility, integration and coordination, motivation, evaluation and control. The points we had in the previous slide somewhat summarized here. Planning and control cycle. Identify the objectives. That means the long-term targets. I told you, like if you are standing here, okay, after 5 years, after 10 years, we must be here. Identify the objective. Identify alternative courses of action. For example, a company that wants to be the largest in terms of sales in 5 years, they can take different approaches. They can be the low cost product provider, like cost leader, one approach, or they can be the differentiated product, like they are technically the best product or most advanced in terms of new technologies. Likewise, they can take different routes, different approaches to achieve this objective. So identify all of them. That's what you call strategy. What strategy the company is going to take. Evaluate each strategy. Choose alternative courses of action. That means choose one of these strategy. Okay, let's say you decided we'll be the cost leader. Strategy chosen. Then how are we going to achieve the cost leader? That is what you mean by courses of action. Identify different ways of achieving cost leadership. Implement the long-term plan in the form of annual budgets. Once you have decided your objective, strategy and courses of action, then start implementing them in the form of annual budgets. Measure actual results and compare with the plan. Respond to divergences. That's what we call variances. Expected performance and actual performance, if it is different, identify why it is different and see what corrective actions can be taken. Planning and control occurs at all levels of the performance hierarchy to different degrees. The performance hierarchy refers to the system by which performance is measured and controlled at different levels. Already I have been telling the 3 layers of management. Corporate level, management level or tactical level, another name. Strategic level, first one. Tactical level, second one. Operation level, third one. So operation level is more kind of day-to-day plans, detailed plans, more focused plans onto a machine, a department, a segment. This is operational plan. For example, what should be the production this week? The percentage of defective units must be within this level. Efficiency of laborers must be at this level. Sales targets for this region is this. These are all operational plans, operational targets. Management control, management targets or tactical targets means for the middle level, annual targets, like what should be the annual profit. A branch manager will have annual targets, annual profit targets, ROI targets. Corporate level, top level management. What is the market share? What has been the growth over the last 5 years? How the share price has moved in the last 2 years. See, these are like not focusing on one department, not specific to one unit. It's like overall corporate. That means the whole company's point of view. That is corporate level. So each level have their own plans, and the performance is measured based on their level of planning. So when we discuss about budgetary control, certain terms we need to understand: controllable and uncontrollable costs, feedback control and feed forward control. Let's see one by one. Managers should be evaluated only by those items within their control. That's the meaning of controllable cost. Let's take an example. You are evaluating a restaurant branch manager. Right. So if you look at the performance of this manager, revenue controllable. He has to promote his branch and invite attract the customers. Direct costs, of course, controllable, like food and revenue costs, because if wastages and all, he has to control, or you can say cost of sales. And like other operational expenses like electricity, water, these are under his control. He can effectively use them or efficiently use them. This answer I call controllable profit. Or before I say controllable profit, okay, let me add a couple of more items. Head office cost, head office overheads allocated to this branch. What is the meaning of that? This restaurant might have 5 branches and a head office. Head office doesn't have a restaurant, that's the management. So the cost of this head office, they will apportion it to these branches on some basis, maybe based on size, based on revenue, something based on investment. So like that, this particular branch manager is also getting some apportioned or allocated head office cost. And then you say this is the branch profit. If I want to measure the performance of the branch manager, these 4 items are controllable by him. This is not controllable. If he wants to reduce head office overhead, can he reduce that? No. Can he take any action regarding that? No. So this is an uncontrollable item. These are controllable items. And always, managers' performances must be measured based on controllable items, not uncontrollable items. Feedback control, feed forward control. Feedback control means you do an activity. Let's say when we are teaching, when a batch finishes, at the end of the batch, if it is a 3-month batch, end of 3 months, on the last day, we give a feedback form. We ask the students to fill. How was the trainer? Did you understand? Did he do questions? Was it helpful? Blah, blah, blah. Now imagine the batch is over. Now you are taking a feedback. What's the point? The batch is over. You can't go back and correct it. But we take it because the trainer is repetitive. He is taking the batches again and again. So if he has made some mistakes in that batch, at least in the future batches, he can correct it. He can correct it. Because of this, we take feedback. So remember, feedback means taking action after the event. Most useful if the event is repetitive. If it is a one-off event, doesn't repeat, then taking feedback is not going to give us much opportunity to correct ourselves. Feed forward control. What is feed forward control? Let's say I'm planning a project which is starting, say, Jan 27, and I made the plan by October 26. I made the plan. I assumed how much is going to be the revenue, how much is going to be the expenses, how much is going to be the profit. All that I estimated when October 26, original estimate. Then, based on this estimate, I was working all the preliminary work I was doing. January 27, I'm going to start the project. December 15th, very close to the project. Now I have worked on this project on the preliminary work. I have more updated information now. Now I check, okay, my estimate was to achieve $100,000 revenue from this project. Based on my recent estimates, are we still expecting 100,000? No, Within these 3 months, the economy went a little down and things are not so favorable. The revenue we can expect is only 60,000. So now I have to think, okay, so if I don't do any action now, I might end up in a loss. So what preventive measures I can take? What extra marketing I can do to increase this 60 to 100? Should I reduce the price? See, I'm thinking of all this before the project starts. This is what you mean by feed forward control. You take the latest update, latest estimate, compare with your original estimate, still estimate, the project did not start, and see whether everything is in line, everything is going well. This is feed forward control. Most useful if it is a one-off activity, because before the event you are doing it. Single or double feedback loop elements include target, sensor, comparator, effector, which I will explain in the next diagram. Look at this diagram. Right. Effector is the one that decides how much input to give, what input to give, what should be the raw material, what kind of labor is required, how much of experience is required, what machine is required. All that is decided by the effector. Based on the effector's decisions, inputs are given to the process. What material, what labor, what machine, what technology, all that. Process makes the output. Output comes out. Before you take it out to the customer, you have a sensor. So what this sensor does, take this output and sends it to comparator. Sensor takes this output and gives it to comparator before giving it to the outsiders. Comparator compares this output with the expected output. Already we will have the expected output, the plan. So comparator compares the planned output and the output we are getting from this process. If everything is okay, if the output is as expected, it tells the effector all good, continue. So effector says input can continue the same way. Suppose if anything was different, cost is high, material is not up to the quality, it tells the effector. Effector then changes the input. Effector will change the input. Then the process, again output, again sensor, compare, until this circle will continue until the product becomes really good. That means as expected it comes. The moment it comes as expected, it will be released out as output. So do you understand the meaning of effector, input, process, sensor, comparator? This is called single feedback loop. Double feedback loop means additionally we are getting this one. Did you see? Single feedback is this. Double feedback we are getting this extra line. What is this? Sensor gives information to high level controller also. Not only the comparator. So maybe some more tactical or strategic decisions also would be taken based on this sensor. So comparator, high level controller, all that will be connected. This is called double feedback loop. They don't ask this in the essay questions, but in MCQs they can give diagrams. For example, one item might be missing, and they can ask, what is this? What item should come here? Likewise, some basic questions are possible on this. Budget setting styles: imposed budgets, participative budgets, negotiated budgets. There are 3. Imposed budget means from top to bottom. Top level prepares the budgets and they send it to the bottom level for implementation. So the bottom level, operational level managers like sales manager, production manager, they don't have a say in the budget. Whatever the top level, the CEO, CFO give them, they have to implement it. This is imposed budget. Participative budget means these operational managers, they get together, they make budgets for their departments, then they send it to the top level asking for approval of those budgets. Sometimes in the first step, the top level might not agree. They might send it back. Then there might be some discussions, arguments, negotiations, and then finally they agree on the budget. This is called participative budgets. Negotiated budget means you don't leave it to one party for the responsibility of budgeting. You don't see in the first one, the responsibility of budgeting is with the top level. In the second one, it is with the bottom level. Here, both parties, they sit together, they negotiate, and they prepare the budgets. So final budgets are likely to lie between what top management would really like and what junior managers will believe as feasible. See, these guys, operation level guys, they have some plans. Top level might have a little more ambitious plans. In between both of their plans, the final budget will lie. Because operation level managers might want it a little easy. Easy budgets, easy targets. Top level might want it more and more challenging targets. So at the end of the negotiation process, it will fall somewhere in the middle. Right. So this is the first part of introduction for budgeting. Purposes of budgeting. Let's see quickly. Purposes of budgeting. And then the planning and control cycle. The levels of plans and the controls. Certain terms: controllable, uncontrollable cost, feedback, feed forward control, feedback control, single feedback loop, double feedback loop, and finally level of participation in budgeting. We studied imposed budgets, participative budgets, negotiated budgets. Then next part, what we are going to study, the different types of budgeting: incremental, zero based, fixed, flexed. All that we are going to see in the next part. Please revise this. We'll join in the next part.